You know that investor who says they're in it for the long term, right up until the market drops 20%? The one who checks their portfolio before breakfast, sees a wall of red, and suddenly starts talking about getting out before it gets worse. Yeah, that person isn't just making a money decision. They're trying to escape a feeling. And if you've ever felt your chest tighten during a crash, if you've ever thought, I know I shouldn't sell, but what if this time is different? Then stay with me. Because panic selling is almost never about numbers alone. It's about what those numbers do to the human brain.
Here's the part most people miss. Market crashes don't just attack your portfolio, they attack your sense of safety. A falling market creates uncertainty, and uncertainty is something the brain hates. It wants closure. It wants control. It wants the discomfort to stop. And in that moment, selling feels less like a strategy and more like relief. Not smart relief, just immediate relief. Psychologists and behavioral researchers have a name for one of the biggest reasons this happens: loss aversion. In plain English, losses hurt more than gains feel good. A 10% gain might make you smile. A 10% loss can ruin your entire day. That's why panic sellers don't experience a crash as a temporary dip on a screen. They experience it like something is being taken from them in real time. And once that feeling kicks in, logic gets quieter. Fear gets louder.
But panic sellers aren't only reacting to pain, they're reacting to speed. A crash feels fast, and the human mind confuses fast movement with urgent danger. When prices fall hard for several days in a row, the brain starts telling a story. Not "this is volatility," not "markets recover in cycles." The story becomes "this is the beginning of the end." That's recency bias in action. We take what's happening right now and treat it like proof of what happens next. Fear turns the present into prophecy.
And then there's the crowd. Panic selling spreads because fear is contagious. If headlines are screaming, if financial TV is breathless, if people online are posting about going to cash, it starts to feel reckless to stay calm. The SEC's investor behavior research has pointed to herd behavior as one of the ways people damage their portfolios. In a crash, people don't just ask, "What do I believe?" They ask, "Why is everyone else running?" And once that question takes over, your brain starts treating other people's fear like evidence. That's why crashes feel so personal, even when they're happening to millions of people at once. Because your screen is private. Your stomach drop is private. Your thoughts at 1 a.m. are private. You're not thinking about long-term market history. You're thinking about your retirement, your bills, your family, your future. And suddenly, what should be a broad market event starts feeling like a direct threat to your life. There's also something almost addictive about checking during a crash. You tell yourself you're staying informed, but most of the time, you're just reopening the wound. Fidelity notes that investors who look at their portfolios more frequently can become less willing to accept risk, and over time, that can hurt returns. In other words, the more often you watch the damage, the more unbearable the damage feels. It's like touching a bruise over and over just to confirm it still hurts. And here's where panic selling starts to masquerade as wisdom. Cash feels safe. Certainty feels safe. At least if I sell now, I'll know what I have left. That thought is powerful because it offers something crashes take away: control. Behavioral research shows people often prefer a known outcome over an uncertain one, even when the uncertain path may be better long-term. So when the market feels chaotic, selling can feel like regaining control of the room. The problem is, emotional control and financial wisdom are not always the same thing. And let's be honest, a lot of panic sellers are not dumb. They're overwhelmed. They may fully understand that markets have recovered before. They may know intellectually that timing the bottom is almost impossible, but knowledge is very different from regulation. In a crash, many people are not trying to maximize future returns. They're trying to stop present pain. Selling becomes an emotional painkiller.
Sometimes it goes even deeper than that. Some people panic sell because market losses wake up older fears that have nothing to do with charts. A childhood around money stress, a parent who lost everything, a memory of 2008. Years of feeling like security could disappear overnight. So when the market crashes, they're not just reacting to this decline, they're reacting to every moment in life when instability meant danger. That's why two people can look at the same drop and have completely different emotional reactions.
And this is where the story gets more complicated. Not every person who sells during a crash is simply irrational. Sometimes they're overexposed. Sometimes they invested money they might need too soon. Sometimes they never had an emergency buffer, so market losses feel like survival losses. Vanguard has emphasized that focusing on things you can control and having even modest emergency savings can reduce financial stress and help people make better decisions under pressure. So before we shame panic sellers, we should admit that fear hits harder when your safety net is thin.
But here's the brutal irony. The very moment panic sellers feel most certain they should get out is often the moment discipline matters most. History doesn't say every recovery is quick. It doesn't say every drop is harmless. But it does show something deeply uncomfortable. Some of the market's strongest days often happen during bear markets, close to the periods when fear is highest. Fidelity found that missing just the 5 best market days since 1988 would have cut long-term gains dramatically. That means the investor who sells for relief often locks in the pain and misses the rebound that was supposed to heal it.
Lazard makes a similar point from a historical angle. Downturns feel chaotic in the moment, but panic selling has repeatedly proven counterproductive because recovery tends to follow major declines over time. The problem is, recovery rarely arrives with a polite invitation. It usually begins while headlines still look terrible. That's why so many people sell low, wait for clarity, and then buy back only after prices are much higher.
That's the real trap. Panic sellers think they're making a 2-step move. Get out now, get back in later. But later almost never feels safe enough. First, they wait for the bleeding to stop. Then they wait for better news. Then they wait for confirmation. Then they wait because they missed the first bounce and don't want to look foolish. And before they know it, the market has already moved without them. So what separates panic selling from smart risk management? One word: planning. Planned selling happens before the emotion. Panic selling happens inside it. Planned selling says, my allocation no longer fits my goals, so I'm rebalancing. Panic selling says, I can't take this feeling for one more day. Planned selling is boring. Panic selling is urgent. And when money decisions start feeling urgent, that's usually your first warning sign. The investors who handle crashes best are not fearless people. They're people who distrust their own fear at the right moments. They know their brain gets louder when uncertainty rises. They know headlines are designed to pull attention toward danger. Vanguard describes this mix of business incentives, biology, and behavior as a force that can push investors into short-term decisions against long-term goals. So the calm investor is not someone with no emotions. It's someone with guardrails. That can look very simple. Looking less often. Keeping enough cash outside the market so every downturn doesn't feel like a personal emergency. Automating contributions. Rebalancing by rule instead of mood. Talking to an advisor, or even just writing down in advance what would make you sell and what wouldn't. These things sound small, but they matter. because they create distance between fear and action. And distance is where better decisions live.
So, if you've ever panic sold, this is the part you need to hear. You're not broken. You're not uniquely weak. You're human. Your brain was built to protect you from immediate danger, not to sit calmly through violent swings in a digital market while doing nothing. The issue is not that you feel fear. The issue is whether you let temporary fear make permanent decisions.
Because in the end, panic sellers are not really trying to beat the market. They're trying to escape uncertainty. They want the noise to stop. They want the red to disappear. They want to feel safe again. But the market has a cruel habit of charging a premium for emotional relief, and a lot of people pay it without realizing it.
So the next time someone sells everything in a crash, don't just call them irrational. Look deeper. Maybe they're reacting to loss aversion. Maybe they're following the crowd. Maybe they've mistaken certainty for safety. Or maybe they were never prepared for risk in the first place. Either way, panic selling is psychology before it is finance. And once you understand that, the behavior stops looking stupid and starts looking painfully human. If this sounded uncomfortably familiar, hit subscribe. And tell me in the comments, when markets crash, does your first instinct say, stay calm, or get me out? Because the answer says a lot more about your nervous system than your investing skills. And if you want the next layer of this, the next video is about why smart people still chase bubbles right before they burst. That one might explain even more than this did.